Welcome back. You're watching us here on Bazaar Morning Call. A bunch of stocks on our radar, a bunch of conversations overnight. Can today be an IT day or not? Will today actually be the day where we see a bit of relief for the bulls after 8 days of relentless selling? Well, to answer a lot of your questions, some of them stock specific as well, we have Amnish Aggarwal, who's the head of research at Prabhudas Lilladher, joining in. Amnish, thank you so much for joining in. Good morning. Two stocks I wanted your thoughts on at the outset itself. First one, of course, is Mamaearth, Honasa, which was down about 20% in yesterday's trading session. Weak numbers coming in. And the second one would obviously be Swiggy, because the Swiggy versus Zomato market cap valuation differential sort of battle is playing out as now both of them are listed. So on both those counters, if you have a view.
Okay, hi Mangalam. You see, as far as Honasa is concerned, I think this is typically what happened in many of the consumer companies. Honasa started with their lead brand focusing on the, you can say, B2C on online platforms. And later on, they went into your all the general trade. Now, if you look at commentary of not Honasa, but many of the other companies, what has happened is that the fast growth of quick commerce has actually clogged the general trade to quite a good extent. And that is why many companies, some might have taken, say, 6 months earlier, a couple of them have taken now. So they are taking some sort of a, you can say, inventory destocking. And Honasa also suffered due to that. The second is that, you see, it is a fairly young company. Today, when it comes to the entire, your particularly personal care, hair care, beauty products kind of a ecosystem, there the competitive intensity today is very high because you are getting all the global brands, courtesy all these platform companies. So I think the going is never going to be easy for, you can say, many of these companies. And given the fact that particularly the young ones where the profitability is not so visible, they don't have a long track record of profitability, I think some reactions of these kinds are likely when the destocking happens at so early a stage. But having said that, I think it's going to take some time for the things to stabilize at Honasa. Okay, so I can't give you exact view that whether one should go or buy now or one should wait, because any which ways there is some sort of a slowdown in demand which is also there. But definitely, I think the times are going to be challenging for the entire space, although one might say that in the coming quarters, the performance of Honasa and many of these companies might show some improvement. Now, your second question was regarding Swiggy. So, you see, once you start analyzing Swiggy, then the typical debate boils down to Swiggy versus Zomato. And when you look at the various parameters in terms of throughput, in terms of margins and some of these, you can see today's Zomato is far better placed than Swiggy. There is absolutely no doubt. The second difference is that if you look at the past 3 years kind of a period, then Swiggy has actually, in the last 3 or 4 years, lost market leadership in the key segments. For example, they were the first ones to start quick commerce. Today, they are, say, number 3. Even in case of food delivery, Zomato has raised ahead of them. So, and in the, you can say, typical marketing scenario, what usually happens is that the leader makes maximum amount of money. So to that extent, I think what is attracting investors to Swiggy is that the market cap of Zomato is, I think, roughly around, say, anywhere 2 to 2.25 times than that of Swiggy. So that is something which is making, you can say, Swiggy attractive to investors. But having said that, if someone wants more clarity in terms of profitability, more, you can say, success in terms of, say, hardcore numbers, then I think Zomato seems to be far ahead than Swiggy at this point of time.
All right, so Zomato's far ahead of Swiggy, even as there is a fair amount of valuation difference between the two. Before we move further, just a quick thought on all these city gas distribution companies, because for twice in a row, GAIL has gone ahead and cut the APM gas allocation to them. The street believes that this is the start of, derating for these stocks. As a result of which, we saw big cuts in IGL, down almost 19% in yesterday's trading session. MGL was no different. After these cuts, do you think that, it makes a case for maybe buy, given the larger opportunity of natural gas or piped gas being delivered to most places?
Okay, see, there are two ways to look at it. One being that they are your allocation from GAIL has been cut. And if you look at over the years, the allocations have not been going up for city gas distribution companies because the gas is also being diverted for some of the other priority areas. Now, from the second angle, when it comes to now move towards the greener fuels, whether it is EV, whether these are hybrids or whether it is CNG, definitely there is a lot of scope. And many of these companies, they actually depend a lot on what happens on the, you can say, automotive front, what happens on the, you can say, domestic PNG also, although I think they make maximum amount of money when they supply to automotives. Now, I think in the longer term, the demand is there, and I believe that even if the supply to them is cut by GAIL, then they will be able to, I think, they will import us and compensate for that. And I think if you look at the past 5-10 years, kind of a longer view, do they have pricing power? The answer is yes. So I think it's a kind of which is a very sharp reaction which has come in. Okay, but having said that, at a lower level, yes, they could be good trading bets.
Amnish, what do you make of this issue? NTPC Green, plenty of interest out there. They're priced it quite favorably as well. Your view?
Yeah, so Nigel, NTPC Green is into, you can say, as a management said, green energy, solar, wind. You see, the closest comparable for that seems to be Adani Green. So if you compare the valuations of, say, Adani Green and this company, then definitely the plans are very ambitious. The growth rates will be high over the years. Is the stock cheap? I would say no. But for the investors who are ready to bet, say, for the next few years, I think the growth will come, and in the long term, one will make money. But definitely at the current price of, say, 8 odd rupees, with a market cap of, I believe it should be roughly around, say, 85 to 90,000 crores. So on a relative basis, you might find it to be attractive. On an absolute basis, I don't think that the issue is it is cheap in any which way.
All right, we take that point. Thanks a lot, Amnish, for joining in.